Support for this podcast comes from the FAU Financial Analyst Program. In partnership with Bloomberg, the FAP Financial Analyst Program provides an educational challenge that builds on relevant, real-world fundamental investment knowledge to educate, train, and develop the next generation of top-notch finance talent. Learn more at business.fau.edu/FAP.
Hello, everyone, and welcome to Nightline. I'm your host, Rainford Knight, along with my co-host, David Greenberg. Good morning, David.
Good morning. How are you?
Fine, thank you. David, last week we heard on the news that the Saudi oil fields were attacked, and that created a tremendous shock globally. Is this a headwind for the global economy? What's your perspective on oil going forward and the economic impact this is likely to have?
That's a great question, and it's something that I've been talking about literally for 20 years since the first Gulf War. So, let's start off with a little bit of a history lesson for your listeners. Most of them that probably weren't born at the time going into the first Gulf War. When Kuwait was invaded back in 97, 98, give or take, you had a quick run up in oil. It was $2 run up in oil, but on a $20 contract, that was a 10% move, which was, really impressive at the time. And then as the buildup kept coming, crude oil kept getting higher and higher. Now there's a day that we call at the exchange the regrettably day. And it's when Baker, who is, one of our top government officials, was talking with Aziz. He was Secretary of State. And, the meeting was supposed to last an hour, lasted 2 hours. It went lower. Then the word regrettably came out. And we realized there was going to be a war, and we rallied $5 in about a minute and a half. So this thing about, this being the biggest spike in the history of crude oil was, just again, the news was wrong. They didn't do their homework. That was a $25 contract at the time, and we rallied 20% that day. So fast forward to the night of the war. Now, the biggest thing that we were worried about was that the Saudi oil fields were going to get hit.
Right.
So the night of the war comes out, I'm long, just a few contracts, about 8 contracts, and I get a phone call that the war started and crude oil's up $8 because they're worried that this is it. I go, being a cocky little kid, I go to the car dealership, I walk in, I'm going to buy that car tomorrow. Luckily, I said tomorrow. So I'm getting phone calls from people that are trading the cash market. We're trying to sell everything we can, $8 higher, $7 higher, $5 higher, and unchanged. I'm like, don't call me back. And then I get in the next morning, and we went from being $8 higher to $8 lower.
That's quite the reversal.
A massive move on a $30-something crude oil price. Think about the numbers on there. I mean, people were getting carried out on that kind of move. But it was simply because they couldn't get a plane off the ground in Iraq, and they found out within hours that the oil fields would be safe.
Got it.
So I've been talking for 20 years, and a stop clock is right twice a day, so it's finally right, and I got a lot of phone calls this week, from some of the, networks and stuff and CNBC. And you always said how you love to be short. I mean, Rainford, I lived to be short. I could have not even had a buy side on my pad until the end of the day. But I always did say I would never go home short, because if the Saudi oil fields ever got bombed, you could see the market rally $20 overnight. This time you didn't, though, but you did see a $5 rally.
Is that and the reason that why the market didn't rally as much as people thought, is that a function of the Saudis came out and said that they will likely repair the pipeline or start to pump fairly quickly? Is that because that bit of news seemed to have calmed the market somewhat in the aftermath of the bombing?
Well, while that bit of news was out, nobody really believed it, because what are you going to say? You're not going to sit there and say, "Oh, it's worse." But really, it's a real attest to what the world has done, especially the United States, as far as oil dependency.
Correct.
20 years ago, it would have been over.
Yes, absolutely.
It's just
absolutely.
We're done. So where I thought that it would come in $20 higher 20 years ago, we have become so efficient and so self-sufficient on our oil and our natural gas that it only came in $5 higher, which is really, on a relative basis, on a $50-something contract, was not a major move. It came right off once Saudi came out with those things. Right. Now it rallied again because they're worried about, Iran making these statements. Right. But the good news is, that there is a bigger chance of gas prices going higher because of the refineries being shut down, because of the flooding in Texas, than what's going on in the Middle East. And that's the first time we can say that in history.
That's interesting because most people tend to miss that. The news focuses on the oil, which is, I guess, one would say it's a headline.
Sure. Everybody loves talking about crude oil. It's like the sexy thing.
But the main street is focused on their wallets, and if the refineries in Texas are going to shut down, because that impact is likely to be more greater on Main Street than it would be than this oil, the Saudi oil.
Oh,
pipeline.
and it goes from Main Street to factories to airlines to everything. And it's funny, people don't understand. This is where a lot of traders would get hit on this, is that crude oil can drop because you can have a glut of crude. Gasoline can rally because the refineries are down,
right.
And there's just no way to refine it.
Right.
So it's where the spreads would get way out of whack. Traders like myself love moments like that because it caught a lot of the upstairs guys off guard. But it is amazing to see how these markets have reacted actually very efficiently, very step by step. No major panic. People are talking, the headlines over the weekend was hysterical. $100 crude. Whenever you see a headline like that, $100 crude, $5,000 gold, sell it, because it means that, it's hit the top.
Well, and along with that news, the Fed came out and did another 25 basis point cut. There was not every central banker or member of the FOMC agreed. The interesting thing, the perspective is, well, if they continue to do this, right, in reaction to what is viewed as a global slowdown, when the recession does hit, what will there be left in the toolbox to stimulate the economy? And that's a big question.
Sure, we spoke about that a few podcasts ago, and it's like when you have nothing to kick in. And the president was, upset that it wasn't a bigger cut. Well, if you have a bigger cut now, good luck doing, as you said, anything, going forward. The fact is, it was really the first double cut since 2008.
Right.
Took a lot of people by surprise. But the interesting thing is that the stock market, everything's trading differently than ever in the history that we've known. You got to take everything in the books and just throw it out.
Right.
It's a new world. It's a new type of trading. It's a new type of thought process. The stock market didn't come off 1,000 points off of that, or it didn't rally 1,000 points. It really didn't move. It came off 200 points and rallied a little bit. But it is a sign that we're going to probably hit a recession. And we've been talking about that for a while.
Absolutely.
That while, these numbers on Wall Street are so good, that probably 99.9%, hence the not 1%, they don't have enough money to make a difference, in the markets. But what I found that was so interesting, being an ex-trader and being somebody that I knew every tick of the market, I knew where everything was. Well, I'm down here and I had lunch with some people like, oh, did you hear what happened when Saudi oil fields got hit? And they're like, what? And I'm like, oh, the market. And even me, I'm noticing that, if you're in the market, you're so focused.
Right.
But the 99.9% of the rest of the country, they've got in their 401ks. They're not looking at it every month. It's not going to affect them even in the short term. But what will end up affecting them is, when this economy slows down.
And to that point, the rate cuts, some have said, they're really crushing savers, right? Because at the end of the day, rates were already really low.
Sure.
Now they're even lower. So if you're saving money on an after-tax basis and plus inflation, you're not getting any kind of return on your dollars. So it's really, for savers, it's a bad thing.
Well, like what we talked about in the past, look at the seniors.
Right.
The seniors, their whole life, they save, which is what you're supposed to do.
Right.
You were going to get, listen, when I graduated college, we got 8% on savings accounts.
Right.
So think about this, the seniors are getting killed. Right. And now the middle class is getting killed on their savings.
Absolutely.
And now every class is getting hurt. So again, our biggest problem is that we don't have a 30-year plan. We don't have a 10-year plan. It's whatever works for the next election. And
it's I don't know. It's going to be interesting because the economy, to your point, is not normal. So the New York Fed went in and are buying bonds. All right, that sort of market interruption or market intervention is a signal that things are not so great. All right, in terms
it's a panic mode. That people don't realize. These are the things that you look back in 3 weeks, 3 months, or 6 months, or 9 months and go, oh, there was a red flag.
Right.
Exactly. Oh, there was another one. Because people don't understand, before every recession and before anything that ever happens, Monday morning quarterback is great, right? But you can literally, and it's a great history lesson, it's a great way to learn. I did my trading based off signs and signals, even intraday, that I noticed a pattern that was happening. And you're going to look back and you're going to see things here and like, oh, this is coming. And coming into an election year, we might see things that we've never seen before.
I do agree with you. To change gears a little bit, another headline item is these so-called startup firms that are now labeled as unicorns, and in particular the WeWork business, and how it is that these companies can raise hundreds of millions of dollars, and the founders of these businesses are acting like it's their own personal piggy bank for them to do whatever, self-dealing. So what's your take on some of these startups and some of this idea around getting to $1 billion valuation and pushing these unprofitable businesses out into the marketplace?
Well, it's amazing. I just came from a startup that, that they had the same view that, we're worth $3 billion. And I'm like, well, you don't have one customer yet. Why? Where they have very few. And if you look at the other valuations of the other, startups and everything, and they're almost feeling like the self-centered of entitlement, where that we're back to the .com days.
Exactly.
Okay.
Exactly.
Where you had these crazy valuations. The difference is that on the .com, their stock prices were out of control. And these guys went from being worth 100 million to nothing. The thing that I find very interesting, especially with these founders that are working as activists and not registering, I think what's going to happen is that the SEC is going to start doing investigations on them. I think that you're right. I think they're double dipping. I think there isn't enough control. And, the whole thing with WeWorks, it's kind of funny. They first were 10 billion, 20 billion, 30 billion, 40 billion. It's like a market. Then 40, 30, 20, 10, we're not trading.
You're right.
Simply because, you and I have had this discussion. I always get a kick out of when I walk into WeWorks or I meet people and they're like, I'm CEO of my own company. Really? What do you do? Well, we're pre-revenue. And my best friend is the CFO. And I'm like, okay, and where's your office? Well, we have a desk at WeWorks. Well, this has worked in the whole feeling of entrepreneurship with this whole phase that if you don't like what you're doing, become an entrepreneur, which you know how I feel. We'll do another podcast on that. That's a topic for a whole nother time. But what's happening is that if 99% of these entrepreneurs, which is no fault of their own, fail, because it's just the statistics, well, I think WeWork's model is flawed, and they're seeing that because they had their spike with the whole Gary Vee and everybody coming out, and entrepreneur, and people are realizing they can't pay their bills.
Correct.
This is a nice idea that maybe it should be a side gig for a while until you're doing it. Right. And I think we're going to see a shift back to where my theory is become an entrepreneur within somebody's business, learn the business, take your time, and then as your next stage in life, that's what you should do. And all these kids that are in there, and they're not so, everybody's a kid to me at my age these days, but these 20-year-olds and 30-year-olds, and they're going to have to go back and find a real job. And I think that's going to hurt WeWork's model. And I think they're seeing that it's starting to turn along with the slowdown, that people aren't so quick. I've tried to raise some money for some of these startups, and they're not writing checks like they used to.
Right. No, exactly.
Because the whole frenzy is a little bit over.
Yeah. Thanks for listening, everyone, to another Nightline podcast. And thanks again to my co-host, David Greenberg. Nightline is part of the FAU College of Business podcast network. Learn more at business.fau.edu/podcast.